All right. Today is Thursday, June 29th. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. We begin with the macro data that we got today. Of course, the shocker from Germany overnight. All of a sudden, we hear that inflation is re-accelerating in Germany. Some regions produce preliminary readings of inflation, and it appears that inflation is rising again in Germany. Of course, some of this is due to base impacts. There were subsidies last year in Germany, and now that the base impacts are over, we see inflation picking up higher again. This is the same thing that I believe will happen here. We got the base impacts cover all the way till June. Then, after July, no more base impacts cover. We could see a rebound in inflation here in the US. And of course, while we got some bad inflation data from Germany, we got some good inflation data from Spain. Inflation fell down to 1.6% year on year, below the ECB's 2% target. Now, I would have loved that CNBC's Sarah Eisen yesterday because she got Lagarde. And instead of asking her this question, what happens if you have one country in the region with sticky or high inflation, and then we see other countries where inflation is going down rapidly, in this case, Germany versus Spain, how would that impact policy? But instead, of course, CNBC per usual, they want to ask everything related to the stock market. Are you going to cut? Are you going to raise in the next meeting? How's that going to impact the stock market? That's all she did yesterday. Sarah Eisen of CNBC. But anyways, the reaction was clear. We got German bonds blasting higher. Even in Britain, the 2-year gilt blasted higher. What does that say? Higher for longer. Central banks will have to do more. The job is not over yet. Inflation will rebound, and central banks will have to hike rates higher and higher and higher until one or two things happen. Either we get into an organic slowdown, aka a recession, the R word, that we're not allowed to say right now, or they break something big and we get a hard recession instead. The R word instead. And then we got some domestic data coming out from the whatever kitchen census this time around. And the GDP was revised up from 1.3% to 2%. It's a huge revision, indicating that the pace of economic activity is re-accelerating again. And of course, we have a lot of speculation. Why did we get such a huge revision in GDP? Zero Hedge says that Q1 GDP unexpectedly revised sharply higher on bizarre surge in net exports. And what were we exporting in the last quarter? Some, of course, speculate that this is due to the weapons that we're shipping all over the place. But anyhow, we also got unemployment data. Initial jobless claims down to 239,000. The estimate was 265,000. So this is below expectations, aka it is inflationary, aka JP doesn't like what he's looking at right now. On top of that, personal consumption rose by 4.2%. Up from 3.8%. So here we go. We're spending more now. The Fed made the mistake of going from 75 to 50 basis points to 25 and now pause. Everybody says, okay, they're done. It's over. Let's go back. And the aggregate demand kicks in. We see reinflation in the economy. And then the Fed will have to come back and be more aggressive. Forget about the pause. Here comes 25. 25 doesn't work out. We're back to 50. You know the deal. And right now, of course, we're talking about the hot side of the icy hot economy. There's a lot of icy, but right now the hot is dominating. When we talk about the hot, it is led by housing. And this is a really interesting piece of data. Liz Ann Saunders says spread between year-on-year percentage change in new home sales and existing home sales climbing up near historical extremes. So when you read the data of existing home sales, and it's down big year on year, you could be under the impression that, oh my God, the housing sector is collapsing in the economy. Nobody's buying homes anymore. But in reality, nobody's really selling their homes. They're locked in 3% mortgages. Are they really going to dump homes right now and look around with no supply available? And mortgage rates at 7%? Of course not. But that doesn't mean that the demand is not here. You look at new home sales, they're selling like hotcakes. What does that indicate? It indicates huge aggregate demand in the economy, meaning we have a put on inflation. Inflation cannot go down too much. It's going to rebound higher again. Reinflation. Aggregate demand equals reinflation. But now, of course, after this slew of data that we got, we have a lot of calls that the recession has been canceled. Forget about the recession. It's not going to happen anymore. Even ex-Goldman Sachs CEO says the U.S. economy is in a tough spot, but may still escape recession. Now understand this. The end of the cycle is marked by a recession. the recession is inevitable. Recession is the last level of inflation. Any inflation cycle is concluded by a recession. The question is, how do we get there? The question is, how fast do we get there? Are we going to get into a recession right away because the Fed is doing the job and cracking the economy down? Or are we going to get there after a period of reinflation, which means the recession delayed? Takes longer to happen. The idea that a recession is not going to happen is beyond delusional. When the Fed raises rates to this magnitude in a short amount of time, you're gonna get a recession. When you have inflation to this level, been in the economy for over 2 years now, inflation is not leaving without putting the economy in a recession. When you have the yield curve inversion to this magnitude, you're gonna get a recession. Just because it didn't happen right now doesn't mean it's not gonna happen. This is the same argument we had back in 06 all the way to 08. We got the yield curve inversion in 06. Everybody says, oh my God, a recession is coming. We get bad data from the housing market. We even got job losses in 07. It didn't matter. The hot side of the economy kept delivering over and over and over and over again. A lot of folks said the same thing. Maybe the recession is not going to happen. Maybe we're going to contain what's going on in the housing market and the economy lives. Whatever happens in the housing market will be contained and idiosyncratic. Until, of course, we got to September, October of 2008. Lehman blew up, took the economy and the market down with it. Systemic risk. Fed kept raising, and then they started cutting rates. But it didn't matter. The lag impacts kicked in. They've been soaking in the icy hot of the economy, real estate, banking. It didn't matter what the hot side of the economy did. At the end of the day, the systemic risk in the icy side of the economy blew up and took everything down with it. So it is kind of ironic that somebody who led Goldman Sachs in the financial crisis actually believing that we're going to avoid a recession this time. Now, here's the last piece of macro data that we got today, and it's not in the hot category. It's in the icy category. We see office vacancies rates moving higher. In other words, all of these commercial real estates, office REITs, what are they going to do? They have billions and billions of dollars worth of debt about to be refinanced right now at much higher rates. Their business is in the toilet. They cannot afford higher rates. They're going to blow up. And then what happens to the creditors? What happens to the banks who these companies owe money to? Now we start talking about the systemic risk. But I know it's, AI is going to take care of it all. Speaking of AI, let's segue to the stock market because it's all about AI. Even the Pope coming out with his own AI scam now. But folks, we have the end of the quarter, so we have to look at the results. Who were the winners in Q2? Number 1, Carnival Cruises. Number 2, Royal Caribbean. Number 3, Norwegian Cruises. So cruises, the hottest stocks this quarter. The thriving business of cruises. And then we have NVIDIA, Generac. Generac did pretty good this quarter. Meta continues to add. Then we have Delta Airlines. You see a lot of new names here. Transportation. A lot of these names got gamma squeezed. Eli Lilly, this is the weight loss mania. Then we have Pulte. Housing remains really hot. And of course, we have Broadcom. That's the AI mania. So the theme is clear. AI and housing. Eli Lilly, this is the weight loss mania. So we have the same 3 winners from Q1 winning in Q2. The difference this quarter is we have transportation, airlines, and cruises. Is it just a gamma squeeze or legitimate rotation? Businesses thriving, perhaps? We'll see. But we know that the stock market is not really cheap. S&P 500 forward PE ratios are not really that attractive at all. And we have an important day coming out tomorrow. Rebalancing, baby. And the headline reads how a wave of selling could soon overwhelm the stock market. What are they talking about here? Much of that rebalancing could happen Friday, the last day of the first half of the year. Wealth managers and asset allocators who invest in various asset classes for families and institutions will want to show clients a healthy diversification of assets. You can't be all in AI. Why not do that when bonds look attractive? And recent stock market rallies faces some risk, ? Stocks could be pressured by managers selling or simply not buying equities, while other investors also sell. A second quarter rise in bond yields has made fixed income more attractive, while a recent run-up in stocks makes them less appealing. See, this is how the institutionals think. Stock market ran too hot. I don't like it. Bonds paying 5% plus. I like it. But we, the retail mom and pops, we think differently. We see the stock market too hot and we choose to chase because the FOMO kicks in. Anyhow, this sets up a likely sell stock, buy bond rebalance ahead of Friday, which is the 30th. And this is according to Julian Emanuel from Evercore. Let's start with how bonds are looking. Well, anyways, we don't need to read all this shit. You can look at the chart yourself. The 1 year is now paying you the highest rate in I don't know how many years, at least a decade plus, over 5.5% for 1 year. Yeah, I'll take that deal any time of the day. And a lot of these managers who made a lot of money in the stock market this year, they want to preserve the gains. Of course, selling equities and paying 50% taxes to the big guy, not pleasant. But can you guarantee that this rally is going to hold? The answer is not really with all the risk ahead. So why not preserve the gain and add another 5% plus, and you only have to hold for 1 year? The resulting allocation to bonds, should managers and advisors do so, could mean they'll pull money out of the stock market. The stock market is riskier and more expensive today than it was months ago, with the S&P 500 up more than 20% from early October. It's bear market low. It is vulnerable to a slowing economy and lower expectations for corporate profits, I should say, as the full impact of higher rates hits the economy with a delay. But nobody cares about the delay anymore, because, AI. One thing that could bolster stocks, however, is that big investors also have tons of cash on the sidelines. A Bank of America survey shows equities managers who handle portfolios worth trillions of dollars have allocated over 5% to cash. And the reason is cash pays now. You can actually make money holding cash. Historically, the cash allocation can dip under 4%, so fund managers have more cash than they can put to work in the stock market. That could counteract any negative stock market impact from people rebalancing into bonds. So the psychology is important tomorrow. What are they thinking? Whatever they do, it's going to be really important for us to know. If they rebalance within other stocks, other sectors in the stock market, aka the rotation, then that says something. If they take profits from AI and big caps, but we see other folks buying and reallocating, then that would say something else. If we have a sell-off in the stock market and everybody's taking their cash out and buying bonds, then that's a different message entirely. So we have to watch what they're going to do tomorrow. And folks, when I talk about volume getting, when we talk about the risk in the market, the unknown, the mechanical risk, we have the ingredients for that happening. And I'm not the only one who says that, by the way. Things like rebalancing could actually be the trigger for an accident. Now Barron says why the stock market's eerie quiet won't last. What are they talking about? Signs of even mild concern are certainly hard to spot. Lately, the CBOE Volatility Index, or VIX, has been bouncing around near 13, a level not seen since before the pandemic. If the VIX, known as the market's fear gauge, is to be believed, investors are frightened as a mouse in a cheese factory while the cat's on vacation. Yet the VIX is deceptive. This is really important for you to know, says Matt Rowe, head of cross-asset strategies at Nomura, by suggesting there is a calm in the market that is not really present. For evidence, he points to the CBOE 1-month implied correlation index, a measure of how much individual stocks are trading in lockstep. It is constructed by comparing the price of options on the S&P 500 to those on the top 50 individual stocks that make it up. It weights investors' collective expectations of how volatile the index will be relative to its components, and is trading at 13, its lowest level since 2017. Put differently, when implied correlation is low, dispersion is high. Individual stocks are moving around in different directions a lot more than the index is. Are you listening or not? For every Carnival Cruises, up 46% in the past month, there is an Advanced Auto Parts, AAP, which is down 40. In a market with a lot of changing components and cross-currents, you tend to get a lot of dispersion, as we are seeing now, Rowe says. That helps explain why volatility appears to be so low. A stock index is, after all, an index of stocks. If half of the components in the S&P 500 rise in a day and the other half fall, the index will be unchanged, and the index level volatility will be sleep-inducing. It obscures the volatility under the surface. However, sometimes the opposite is true. The ultimate period of high correlation in the S&P 500 was in March 2020, when the onset of the pandemic promoted a dash of cash. Investors reduced their holdings of practically all stocks, sending them sharply lower in unison. The 1-month implied correlation index jumped to 87 points, while the VIX hit 83. Don't expect that kind of spike without some sort of a crisis, but the low index volatility, high dispersion backdrop won't last forever. We don't need a shock to get more index volatility, just a return to normal. One catalyst for a volatility rebound could be a second quarter earnings season, which begins in mid-July. Many stocks are up a lot going into their coming reports. There is a potential for sell the news earnings season, should management teams remain cautious or results disappoint. Whatever the cause, because douchebag strategist argues that the S&P 500 is due for a modest sell-off. The index has not had a 3% drawdown since March, putting the duration of the current rally in nearly the 90th percentile since World War II. And you might want to wake up right now. Here it is. Correlations are now at lows previously seen only in late 2017, early 2018, right before the Volmageddon sell-off. Ta-da! A pickup in correlations would drive volatility higher and has historically been associated with a market sell-off. The message is, hold on to your diapers. And lastly, let's talk about the bank's stress test because it appears that everything is hunky-dory. All the banks passed in a recession scenario, no problemo. But they did not really test for the immediate threat, which is higher interest rates suddenly in a short amount of time. We have to face them not in 90 days, as they test right now, but in a shorter period of time. Silicon Valley Bank blew up in 48 hours. Yet the Fed did not even bother test for that. But I want to bring your attention here. Forget about the stress test right now. The question becomes, we have a major problem in the banking sector right now. And it's not just exclusive to regional banks. Even the big banks are facing the same problem. Now, the big banks have a lot of cushion, at least right now. But the assumption is rates will have to go down. If rates continue to go higher, we're gonna have a problem, even in the big banks. Here's the headline. Bank of America nurses $100 billion paper loss after a big bet in the bond market. What are they talking about? Here it is. Now that yields have risen and bond prices have fallen, the value of Bank of America's portfolio has plunged. By contrast, JP Morgan Chase and Wells Fargo, the nation's first and third largest banks respectively, each had about $40 billion in unrealized bond market losses, while the fourth largest, Citigroup's paper losses were $25 billion. So we have a problem here in Bank of America. BOFA Chief Executive Brian Moynihan has done a phenomenal job in handling the bank's operation. Really? Said Dick Bove, a veteran bank analyst who's the chief anyways. But if you look at the bank's balance sheet, it's a mess. Amen. Bank of America has said that it has no plans to sell the underwater bonds, avoiding crystallized losses that for now exist only on paper. The bank's portfolio consists of highly rated government bank securities that are likely to be eventually paid back when the underlying loans mature. Here's the problem. But holding on to the relatively low-yielding investment, many of which are backed by 30-year home loans, at a time when newly purchased bonds yield significantly more. This could limit the income that BOFA can generate from its consumer deposits. BOFA has $370 billion in cash and is not facing any SVB-like liquidity crunch. In fact, BOFA and other big banks have received inflows of deposits from customers of regional lenders. Most home loans are paid off far earlier than their 30 years term. If interest rates were to fall again, then BOFA's bond holding would regain value. Yeah, that's if. The problem is, look at this, the annualized net interest margin, they're doing way worse than JP Morgan because of this. Now, JP Morgan is the gold standard. If you must own banks, you gotta go with JP Morgan. I don't know why would you invest in banks right now, but to each his own. To summarize, folks, we talked about macro data from Germany, inflation rebounding. We talked about macroeconomics data here in the US, coming out hot, aka positive, but opening the possibility of reinflation. Then we talked about the market conditions. We have rebalancing coming out tomorrow. Lots of things to watch for. And most importantly, we're watching about when it's going to happen, not if. The inevitable. This crunch and volatility will cause a mechanical accident. We're waiting for the trigger. And lastly, we talked about the bank stress test and the problem with Bank of America having over $100 billion in unrealized losses. And as rates continue to go higher, those losses will accumulate. Not a problem for now, but for how much longer? And with that, folks, we have reached the conclusion of this video. If you happen to be a member of the channel, we have produced market analysis with a lot of charts, option discussions, Q&A. Go check it out. But folks, with that, this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.